Gold has been shining recently. Prices have jumped more than 10% in the past 2 months. Gold closed today down slightly at $1,771 an ounce. What's the outlook from here, and what's the best way to invest in gold? So tonight's word on the street, gold. And joining us, Joe Doe, reporter from TheStreet.com. So Joe, where do prices go from here on gold?
Well, in the very short term, like this week, you might see gold just trade sideways, but people can't forget global troubles, specifically the Eurozone. There's a lot of talk about stimulus coming up in the Eurozone, possibly with Spain, other countries. And if that stimulus hits, you're going to see another gap up in gold. In fact, an analyst this morning was telling me his 12-month projection, he could see gold ounces going for as much as $2,300.
2,300. And what's really going to drive that? Yes, I hear you about tensions in the world, but what's the real driver here? What are analysts telling you?
Well, analysts are saying that maybe we should also look at some stocks. I mean, obviously you're going to see gold gap up because of global easing in markets like Brazil and even in China. But you really do have to look at some of these gold miners, and they are the ones that you can actually make a little bit of a profit on as the price of gold goes up.
Yeah, and analysts have been giving you the names of a couple of good gold mining stocks, and let's go down some of them. Let's pull up the chart here of Barrick Gold, and looking at the chart, a very nice move on this stock since August. Why should investors take a look at ABX?
Well, people have to look at Barrick because they have a large amount of production. And when the price of gold goes up, that means that they're going to have a higher cash flow. These companies like Barrick, they're cash flow positive. But we're also going to see with someone like Barrick is their operating margins are going to open up. The problem for someone like Barrick has been for past 6 months that operating margins were squeezing because of high operating margin inflation. But now with the price of gold going up, those margins are going to open up.
Let's take a look at your next one that you've been hearing about, Newmont Mining, NEM, trading here on the big board. Why do analysts single out this company?
So Newmont Mining is a household name. An analyst was telling me this morning that your generalist investor is looking at them for exposure. And they're seeing that a large cap company like Newmont is very attractive because of the liquidity that the company brings. But beyond the liquidity, you also realize that it's a high cost producer and it has a large amount of resources. So they can scale up the size of the projects that they have in place already, which makes it a great investment opportunity for anybody who's looking for growth in a company.
All right. And a third company to consider, which is not a household name like Newmont, is a small gold mining company you tell me about, Allied Nevada Gold. The ticker symbol there, ANV. What's the story on this one?
Allied Nevada has a large development production that's low grade in Nevada. And the balance sheet looks pretty healthy, and a lot of people are saying that the stock is very price sensitive. So low grade production in Nevada means that investors can immediately see if the operating margins of this company gap up with the price of gold. It's right here in the United States. And so when they see that, they'll see that there's enough leverage for the share price of this company to jump up. And very quickly and respond very quickly. But finally, they're also going to see a massive increase in production. They're at about 150,000 ounces of gold average right now.
All right.
And they're going to jump up to 580.
All right. Lot to think about. Joe, do you have any disclosures to make? Do you own any of these stocks?
I do not own any of these stocks now.
Okay, Joe, thanks a lot. Joe Doe from TheStreet.com.